Hi guys, it's the beginning of March, so I want to give you a quick update on my Celsius position, but also share with you 5 stocks that are under my radar as potential buys. This video is very different than my usual video because it's unscripted. It will just be me speaking like this to the camera. Since I know it's very important to give immediate value in every YouTube video, I will start giving a couple of picks, then we will talk about Celsius, and we will end up with more buying opportunities. Always remember, this is not financial advice, it's just YouTube entertainment. Here, a trick of today. Now, one sector that I find very compelling and very cheap is cosmetics. Almost all the companies are down quite a bit. For example, Ulta Beauty, Ulta, ticker Ulta. It's down like 37% since the high of some months ago. It got like its 17 billion market cap with 1 billion of free cash flow, and they use most of this free cash flow to buy back shares. They have very little share-based compensation, so if you see the outstanding shares are actually down. Now, I'm not saying of buying it now or buying it immediately. I'm saying it's a very, very cheap company. It's worth researching. One thing that is a little bit a red flag for me is that Buffett bought into this company and then sold it 6 months later. It's kind of, it makes me think, okay, maybe he found some red flags inside the management, or maybe there is something that it was not really convincing him. Anyway, under a valuation and under my value ratio standpoint, this is cheap, it's worth researching, and I think it could be a good pick. But a pick that is even better, that I think is even more compelling, it's CELH Beauty, ticker CELH. This stock is down like 68% in a very short time and is now trading at the level of 2 years ago, but they have like 3 times the revenue. Also, CELH Beauty is way more modern company compared to this all other like big cosmetics giants. And it's more into social media, and like young generations are crazy for their brands. They have like several brands, but they are just better into modern marketing techniques. And I think, and they're growing very rapidly. Last quarter, like the stock crashed, but actually they were up like, I don't know, 30% compared to revenue compared to 1 year before. I think that it's very, very interesting. I will make a video dedicated if I open up a position in CELH, but check it out. It's really it's very compelling. It's very, very cheap. Now let's move into Celsius. So around a month ago, the 3rd of February, I made a video about how I found Celsius extremely, extremely cheap. And so I opened a position. I bought 500 share at 24.62. Now I made this portfolio so we can check out all my trades and see if I can outperform the S&P, or if not, if I will gain money or lose money. For people that follow me, I think it's more legit, it's more fair if I show exactly how the results are going, how the trades are going, and we can keep it track together. We can see if I gain money, hopefully, or maybe lose money. Let's hope not. But anyway, I think it's something fun. It could be interesting. Anyway, so I opened this position, and since there, the shares have been like a complete roller coaster. It went down to 21, then it went up to 34 at a certain point after earnings, and it crashed all the way down. Now we are at 25, 26. I mean, again, I'm not a trader. I don't care. I don't care about this kind of movements. I just have a thesis that plays in the long run. It will place in the next year or a couple of years. And yes, I just think in the long run, they will create value and my share will go up. So let's wait and see. Anyway, the earnings were like a big deal. There is a lot going on, and there is also things that actually change my valuation. So I think it's important to give an update and see exactly the value of Celsius now, if it's still worth a buy or not. So there are like 3 parts in Celsius, I would say, the good, the bad, and the ugly. Let's start with the good. The good part is clearly this Celsius acquisition. This is the big and the best part of these earnings. They acquired Alani Nu, that was a competitor brand that was actually taking some market shares from Celsius. And so they say, you know what, let's buy, let's this problem, let all these analysts that say, oh, Alani Nu will destroy Celsius, you know what, we buy it, so this problem went away. Now, the other very, very good part is that it was really a deal. So this Alani Nu make around 600 million in revenue, margin of around 15%, and a growth of 20%. Risk, assess the risk as decent high, like 20, I gave 25 out of 100, and then around the value ratio on the Alani Nu. And the value ratio is under 10. So basically they bought this brand that is the biggest competitor and they pay very, very cheap. They pay like 1.8 billion, but with, I don't know, tax advantages like this, it comes like 1.65 billion. If you run the value ratio on the number, they actually pay a very, very good price. And I think that is important. Like, honestly, I hate when companies acquire other companies, because usually for shareholders, it's very bad. Usually they always make very bad deal. It's always a value destruction in some way. And so the company, after acquiring another company, usually they value less. This is one of this very rare case where the management, that honestly I think it's quite capable management, made a very, very good deal. And so actually they create value for Celsius instead of destroying it. Another very good part of this earnings of Celsius was the international expansion. That is a big part of my thesis, that there is room to grow for Celsius internationally. I think I'm based in Europe, and I think in Europe there is room, there is like a market for a brand like Celsius. So yes, international expansion, like I think they grow 39% year over year. Very, very nice. That's what I want to see. I want to see this grow, keep increasing, keep going at this pace. The bad. Let's talk about the bad. So there were several things that were not exactly what I wanted. The biggest red flag is that the sales keep going down. They're still down year over year. And it was not anymore a Pepsi kind of rebalancing of their stocks. The brand lost market share. If you see the chart that they put out of this research, they have less market share compared to a year ago. That's very bad. But they're losing market share to a brand that they just bought. So I think, yes, overall, I'm not super worried. It's not what I wanted to see. I want to see the sales keep increasing, go up from here on. But I think it will need time. It will need the next quarter. Also, the management already said that this quarter will be soft. That's also not very good. But I will give it time. I will give it 3 months, 6 months, 9 months. And I think in 9 months, things will be different. Another bad part is that looks like if a brand like Alani Nu can come and disrupt the market and take some market share from Celsius, it really makes you wonder, okay, but what about this moat? And now I have to think, okay, I was really too optimistic. There are much more risk. One of the biggest risks is that they cannot really build a strong moat, and that they will always have to acquire new players that come up and eat part of their meal. This, it's something, it's kind of bad. If they have no moat, it's bad. So I decided to raise my risk score from 9 to 25. Another reason why I raised it so much is this acquisition of Alani Nu. It gained 30% in the moment that the acquisition was announced, but it's not closed. They will close it in 6 months. There is still a lot of going on. They have to make the due diligence. I don't know, antitrust or it's not a done deal. So there is a risk that maybe something happen, and if something happen and they don't close the deal, then it will be bad for the share. I imagine they will crash back down at 30%. So we have kind of to include this risk that now exists. It was a good deal, but it's not signed, it's not done. It will be done in the coming 6 months. And so I think it's fair to raise the risk score to 25 when we evaluate a brand like Celsius. Lastly, the ugly part about Celsius right now. And the ugly has more to do with the overall market. When I bought Celsius a month ago, I had a value ratio score of 15 against a market average of 26. Then the value ratio went even lower when it was at 21. It was like half price. You could buy a brand that was for half price what I thought it was a fair value. Let's say, price of 21 with a fair value of 42, 44. So it was really cheap. Now it's different because in one hand, I increased the risk of Celsius. In the other hand, the stock already went a little bit up, not much, but 4 or 5%, it is something. But more importantly, the overall market value ratio and the overall market valuation went down. Like, we are in this phase of extreme market valuations. If you see like the historic number of the price to earning ratio for the S&P, for example, they are extremely high. So it is in a way expected the valuations to come down. But my valuation work that I compare the value of a company with the value of the overall market. So if the overall market it's very overvalued, we think, okay, why this company is not, why this company is not overvalued like the rest of the market, and that company looks cheap. And that was the case, like Celsius looked really cheap compared to the overall market. But if the overall market is still, it start coming down, so for example, now the value ratio of the overall market is already at 25, it was 26. So before we were in a situation with value ratio of 15 versus a market average of 26, and now we are at a situation where the value ratio is around 18 with a market average of 25. I mean, it's still cheap, but it's not so cheap like when I bought, at least in this kind of comparison. The value of Celsius now is still around $40. I want to see the company go to $40, and I will not sell it before that. So, unless the situation changes, there is a recession, the overall valuation go down, Celsius price maybe stay the same, it's very different, because then maybe we have other occasions somewhere else. We didn't lose money with Celsius because maybe, it keep holding and it will be still a good deal. We just have to beat the overall market. But yes, I think so. I think it's less compelling. I think it's still cheap, but not so cheap like it was 1 month ago, clearly. And yes, but anyway, I plan to do nothing and keep holding my share. I want to see, again, I'm not a trader. If I would have been a trader, the right moment to sell was right after the earnings with a very good news. Boom, price exploded. You make a good trade. That's it. You cash in. It would have been nice. I didn't do that. I'm not worried. I keep holding. I want to see how it plays in the long run. So Celsius is a little bit less compelling, but there are a lot of other companies that are more compelling. Some that I'm really looking carefully, because I think I will open a position in some of them soon. Some I will disclose in this video, some I will disclose in my next videos. It would be great if you maybe follow me, or if you give me a like, a subscribe. So a sector that I find is overall very cheap, is kind of chronically cheap, but I think there are good opportunities, are shoemaker. Like in general, shoes company are kind of cheap. For example, Crocs already in the past got some very big trade and occasion, but again, we are again at a point where Crocs seems cheap. I mean, it's a very volatile stock, so it can keep going down. So I'm not buying yet, but I'm watching it carefully because the value ratio says it's very cheap. Another one that is very cheap still in the shoemaker business is Skechers. They don't trade at such a high valuation. They are down like 20%, but if you see like the 10-year revenue trend, it's like they keep compounding revenue at like 10% year over year, a value ratio very low and a price to earning ratio quite low. I know the problem there is that it's an extremely competitive business. There is no like really expansion of the TAM because everybody has shoes already. So, I mean, it's kind of anyway, it's a special kind of sector, but I find it overall quite cheap. Another cheap shoe company, to maybe the most compelling of all, is Deckers Outdoor. They are actually down 40% from all-time high, increasing revenue, compounding year after years. They're very successful. Yeah, I don't know. I have to research more, but that's what I want to say. Please research this sector because I think that there are very good opportunities there. Or anyway, companies that are currently cheap. So now actually with these 3 stocks, we're already at 5, but I want to give you some more also because there are just 2 sectors. So let's think something else, something different. Let's go to technology. In technology, I think one that got destroyed by the AI revolution, it really got smashed, is Shutterstock. Got completely annihilated by Midjourney. And if you see, Midjourney is so cool. I love Midjourney. On the other end, if you see the chart, I think they are down like, 80%, 85%, something crazy. The revenue is not so much down. Of course, they have a lot of problems. For example, the earning per share and in general, the free cash flow, it's very down. So it is very risky. I feel like it's a very, very risky play, but I also feel it's very, very cheap. So it's something of like, we just need a little bit of mood shift. Like, for example, if artificial intelligence starts slowing down or start like, whatever, people call to the bubble of artificial intelligence and something happen, I feel like this company will rebound big time. Also, we don't need a lot. Now is I think at $21. I think even if we keep the downtrend, because there is clearly a downtrend, or clearly in the long run, artificial intelligence will win. But we just need a small rebound to make like a 50% gain in, 6 months. This could really happen easily. I think, and again, I'm not buying. It's just something that I think is worth researching. Shutterstock, ticker SSTK. So anyway, there is really a lot of good companies that I would need to study much deeper and keep digging. One that I don't have to study much deeper, and I know it's a good deal. I already spoke about it into a video, but from the video, the stock actually went to my target price, is Google. Google is now trading at 170. Full disclosure, I haven't opened a position yet. Otherwise, I would have added to my portfolio. I will make a video if I open a position on Google, but I think Google now it went there. Like, I have a fair value of 250 and now the shares are like 170. It's 50% undervalued. So they have to gain 50% to just arrive to their fair value. And company like Google, I can easily see go over like the market average. And again, the problem of Google is this problem of losing market, losing search, losing like search revenues, search shares. LLM and in general artificial intelligence will change that business, but it will take much longer than people think. Google have incredible other business. They have YouTube. We are here on YouTube, we are giving money to Google. So I don't know. Anyway, please research Google because I think it's really compelling at this price. And I might open a position soon. Again, I will make a video if I do. Just follow. If you want more details about why I'm very bullish on Google and you want to know the details about the business, check the next video and let me know if this format is also fine, if you can understand me, or if you prefer my usual valuation format video. This is just an experiment. I want to know how people react. I want to know if you like to have more like, hanging out with me kind of content, or if you prefer a straight to the point, value this company kind of video. Thank you again. Please subscribe. Peace out.